Why do the rich keep getting richer? This question has sparked countless debates and discussions around the world. It's a phenomenon that has intrigued economists, sociologists, and ordinary people alike. Is it merely a matter of luck? Or is there a secret formula that only the affluent know and use to their advantage? The answer lies in a combination of factors, each playing a unique role in the accumulation of wealth. Let's dive into the first reason. Firstly, the rich have better access to information. Imagine the financial landscape as a grand chessboard. The affluent, like seasoned chess masters, always find themselves several moves ahead. How? Well, they have a secret weapon, access to insider information. This doesn't necessarily mean illegal trading secrets, but rather a deeper understanding of market trends, economic shifts, or potential investment opportunities before they hit the mainstream. Moreover, the wealthy have the luxury of top financial advisors at their beck and call. These wizards of finance, with their expert knowledge and years of experience, provide invaluable guidance that can turn a good move into a great one. Lastly, let's not forget about premium financial services. These exclusive services, often reserved for the rich, offer a variety of advanced tools and resources. They provide a wealth of data, analysis, and personalized advice, making navigating the financial seas a breeze. Access to information is just the tip of the iceberg. Secondly, the rich know the art of diversification. Diversification, in essence, is a risk management strategy that involves spreading investments across various financial instruments, industries, or other categories. It's like putting your eggs in different baskets. By not having all their wealth tied up in one business or sector, the wealthy protect themselves from unforeseen market downturns. Imagine if you invested all your money into one company and it goes bankrupt. You'd lose everything. But if you spread your investments across 20 different companies in various sectors, the impact of one company going under is significantly less. And not only does diversification reduce risk, it also increases the potential for higher returns. When one sector performs poorly, another might be thriving. So the losses from one investment could be offset by the gains of another. This balancing act is what makes diversification such a powerful tool in the world of finance. Thirdly, the rich have powerful networks. Now, let's unpack that. You see, networking is not just about exchanging business cards at a corporate event. It's about forming meaningful relationships that can open doors to countless opportunities. Imagine this. You're at a gathering and you strike up a conversation with someone. That someone happens to be a venture capitalist looking for a promising startup to invest in. You pitch your idea, and voila, you've just landed your first big investment. That's the power of networking, and it doesn't stop there. Networking can also lead to strategic partnerships. These alliances can significantly boost your wealth as you combine resources, share risks, and capitalize on each other's strengths. We've all heard the saying, it's not what you know, it's who you know. For the wealthy, it's a combination of both. They leverage their knowledge and their networks to keep their wealth growing. The power of networking should not be underestimated. Fourthly, the rich benefit from economies of scale. Now, what does that mean? Simply put, economies of scale is the cost advantage that arises with increased output of a product. The more you buy or produce, the less it costs per unit. Imagine running a lemonade stand. If you buy one bag of sugar, it may cost you $2. But if you buy 100 bags, the store might sell it to you for $1.50 per bag. That's economies of scale at work. For the wealthy, this concept applies to almost everything they do. They can buy products in bulk, invest large sums of money, or run big businesses, all of which reduce their per unit costs. This allows them to save more, earn more, and continue to expand their wealth. It's like a snowball effect. The bigger the snowball gets, the faster and larger it can grow. Economies of scale provide a huge advantage to the wealthy. Fifthly, the rich are masters of tax optimization. So, what is tax optimization? It's the art of using legal strategies to minimize tax liabilities. And no, it's not about evading taxes. It's about understanding the tax laws and using them to one's advantage. It's about making smart decisions that allow for more of your hard-earned money to stay with you. Now, how do the rich do this? They often hire top tax advisors to guide them through the labyrinth of tax laws, helping them make the most out of every tax break and deduction available. They invest in tax-efficient assets, and take advantage of tax-deferred or tax-free investment accounts. They strategically time their income and expenses to minimize their yearly tax bill. Remember, every dollar saved on taxes is another dollar that can be invested for growth. So, the rich don't just work hard for their money, they make their money work hard for them. Sixthly, the rich consistently reinvest their earnings. Now, what does this mean? Well, it's not just about making money, it's about making your money work for you. Picture this. You've just made a tidy profit from an investment. Rather than spending that profit, you put it back into another investment. This is what we call reinvestment. Reinvestment is like a snowball rolling down a hill. At first it's small, but as it continues to roll, it gathers more snow and grows larger. That's exactly how reinvestment works with your wealth. The more you reinvest, the larger your wealth grows over time. But remember, it's not a get-rich-quick scheme. It's a long-term strategy that requires patience and consistency. The rich understand this, and that's why they keep getting richer. They don't just earn, they reinvest, allowing their wealth to compound and grow exponentially. Reinvestment is a powerful wealth-building tool. Keep reinvesting and watch your wealth grow. Seventhly, the rich own assets. Now, it's not just about having money in the bank, it's about how that money can work for you. Think about properties, businesses, and stocks. These are not just possessions, they're assets. These assets generate passive income, money that comes in without you having to work for it every day. Imagine owning a building and collecting rent from tenants, or owning shares in a company and receiving dividends. That's money working for you. And it doesn't stop there. The value of these assets can also increase over time. A property purchase today could be worth double in a decade. A startup you invested in could become the next tech giant, multiplying your initial investment. So, it's not just about the income, it's about the potential for growth. The rich understand this. They don't just accumulate wealth, they make their wealth work for them. I hope you are enjoying the video. Please like and subscribe for more content to boost your journey to financial freedom. Eighthly, the rich have better access to capital. Now, this isn't about being born with a silver spoon, it's about strategic wealth management. Imagine you have a promising investment opportunity, but to seize it, you need more funds. Who do you think banks or investors would prefer lending to? Someone with a proven track record of wealth accumulation or someone without? This is the beauty of having capital. It gives you clout. The rich can leverage their wealth to borrow more money for investments. They can take more significant risks, explore more opportunities, and potentially reap larger rewards. And with each successful venture, their access to capital increases even further. It's a virtuous cycle that compounds wealth. In essence, money attracts more money. The rich use their existing wealth as a tool, a bargaining chip, to create more wealth. It's an ongoing process, a financial marathon, not a sprint. Access to capital is a game changer. Ninthly, the rich have a higher risk tolerance. This might seem counterintuitive at first, but let's break it down. Risk tolerance is the degree of variance in investment returns that an investor is willing to withstand. It's about how much potential loss you can stomach in pursuit of potential gain. Now, the wealthy aren't just cavalier about risks. They understand that with higher risks can come higher returns. They have the financial cushion to absorb losses, which enables them to venture into riskier investments such as startups, real estate, or the stock market, where returns can be significantly larger. The rich also tend to have a diversified portfolio, which spreads the risk and can offset potential losses. But remember, this isn't about reckless gambling, it's about calculated risks, informed decisions, and strategic moves. So, what's the takeaway here? Well, increasing your risk tolerance isn't about throwing caution to the wind. It's about understanding the game, playing it smartly, and being prepared for the bumps along the way. Risk tolerance can greatly impact wealth accumulation. Tenthly, the rich can influence markets. Now, this might sound a bit Machiavellian, but it's an undeniable truth. Those with significant wealth have the power to shape markets to their advantage. They can do this in a myriad of ways. Consider how a billionaire can make a sizable investment in a small startup. This can cause a ripple effect, attracting other investors, driving up the company's stock price, and potentially even swaying the direction of the entire industry. This isn't just a hypothetical scenario, it happens frequently in the world of finance. Or, think about the impact of a wealthy individual publicly endorsing a product or service. Their endorsement can boost sales, increase the company's market value, and even steer consumer trends. In essence, the rich don't just participate in the market. They have the power to manipulate the market's tides, turning them in their favor. Market influence is a powerful tool for the wealthy. 11thly, the rich build brand equity. Now, what does this mean? Brand equity is the added value brought to a product or service due to its brand name. It's the difference in price that a consumer pays when they purchase a branded product compared to a generic one. Now, think about this in terms of personal branding. The wealthy often have strong personal brands that they've cultivated over the years. They're recognized, respected, and trusted. This personal brand equity opens doors to opportunities that might not be available to others. Whether it's partnerships, investments, or even better deals, a strong personal brand can attract these opportunities like a magnet. It's about more than just recognition. It's about the reputation for quality and reliability that comes with a strong brand. This isn't just for celebrities or business tycoons. Anyone can build their personal brand and start attracting these opportunities. It takes time and consistency, but the potential rewards are enormous. 12thly, the rich use philanthropy to enhance their public image. Philanthropy, the act of promoting the welfare of others, usually through donations of money, time, or resources, is a powerful tool that the wealthy frequently employ. This isn't just about being generous for generosity's sake. Philanthropy can also serve as a strategic investment, opening doors to new opportunities. When the wealthy give, they often receive in return. Their donations can generate goodwill, enhance their reputation, and expand their influence. It's a win-win situation. Moreover, philanthropy can offer significant tax benefits. In many jurisdictions, charitable donations are tax-deductible, providing a financial incentive for the wealthy to give. This is a clever way of making money while also making a difference. Lastly, the rich explore global opportunities. In our interconnected world, wealth isn't confined within national borders. The affluent understand this and make their money work for them globally. They invest in foreign markets, real estate, and even startups across the world. These global ventures allow them to tap into diverse economies and sectors, spreading their risk and increasing potential returns. They're not bound by geographical constraints. Instead, they're always on the lookout for the next big thing, wherever it may be. This could be a tech startup in Silicon Valley, a real estate development in Dubai, or a green energy project in Scandinavia. By investing globally, they're not only growing their wealth, but also contributing to global economic growth, fostering innovation, and creating jobs. It's a win-win situation. They're not just getting richer, they're making the world a richer place too. And that, my friends, is how global opportunities can provide significant returns. So, these are some of the reasons the rich keep getting richer. Wealth creation isn't a mystery. These aren't secrets, but strategies, available to anyone willing to learn and apply them. If you enjoyed this video, give it a like, subscribe to the channel, and don't forget to hit the notification bell to stay updated on future videos.